Over the recent months, we've experienced the fastest and most severe economic contraction since the financial crisis, and not since the Great Depression have we seen levels of unemployment as high as today. So, given the economic damage and continued uncertainty, why are stock prices so disconnected from the economy? And how should investors position themselves given this concerning disconnect? For even a little more perspective, I have 6 portfolios here which shows their respective performance since all-time highs in roughly mid-February. The US total stock market index is down only roughly 13% over this period. More risk-neutral portfolios, including the Golden Butterfly and a regular 60% stock, 40% bond portfolio, are both only down roughly 7% over this period. However, if we take a look at 2 other portfolios, one of them comprised 100% of Berkshire Hathaway stock, aka the Buffett portfolio, and the other one being the basket of the 5 largest tech companies in the United States. During this period, Berkshire Hathaway's stock has severely underperformed both that of the market and the largest tech stocks. The disparities between the performance of these 2 groups of stocks is actually something we'll cover a bit later. So when looking at the overall stock indices, it appears we've seen this V-shaped recovery, but this is an apparent disconnect to what's actually going on in the economy. With the unemployment rate at nearly 15%, these are the highest levels of unemployment that we've seen since the Great Depression. In addition to that, while the rate of initial jobless claims has been decreasing, there are still millions of Americans filing for unemployment each week. If these trends continue through most of May, it's possible we'll see unemployment levels above 20%, rivaling that of the Great Depression. Real gross domestic product decreased roughly 5% in the first quarter, but keep in mind that that only had roughly 1 month of economic impact priced in. The year-over-year change for real gross domestic product in quarter 2 of 2020 is expected to be much worse. It's expected that in the second quarter, we'll see a full quarter of decreased levels of demand, as well as the potential for some bankruptcies. So given this broad and sudden decline in economic activity, how is it that stock indices are quickly approaching all-time highs? As you're likely aware, this is due primarily to intervention from the Federal Reserve. The Federal Reserve is engaging in the most aggressive quantitative easing programs that we've seen in US history. Quantitative easing is just another fancy word for printing money. Now, the Fed doesn't actually print money, but what they do is they digitally purchase bonds issued by the United States government from an account which they just add new dollars to.
Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
So effectively, when the Federal Reserve buys bonds, they're printing new money into the economy. Since September of 2019, the Fed's balance sheet has increased by over $3 trillion, meaning that $3 trillion of new money has been flooded into the economy in a very short period of time. Another explanation as to why the markets appear to be ignoring the economic realities at hand might be in part due to the Plunge Protection Team, more formally known as the Working Group on Financial Markets. This group's objective is to provide stability to the markets during periods of extreme volatility. To put it bluntly, they try and prevent stocks from going down. The primary way they do this is by using and buying futures contracts to try and push up the price of stock market indices. What I find interesting, though, is that during periods of overvaluation, high stock prices never seem to be a concern. It's only when stock prices quickly fall back down to match economic reality that suddenly this volatility becomes a pressing issue. So with the Fed literally printing trillions of dollars and the Plunge Protection Team at work, the market is up roughly 30% since the lows on March 23rd. However, a prudent question to ask is this sustainable, and what are the implications for investors going forward? Well, one of the most direct implications is that if the stock market is unable or is not allowed to correct and have prices fall to reflect the expected decline in earnings, then valuations for the average stock in the market will likely remain quite high. The Shiller PE ratio is just one measure of those valuations for the general market, and currently it's at the highest level since only 2 periods in history, one of them being the dot-com bubble of 2000 and the other one being the stock bubble of the late 1920s, both of which were followed by a significant crash in stock prices and inherently stock valuations as well. So far, given the recent market rebound, we haven't seen that level of correction yet, and as such, stocks invested through an index are at still one of the most expensive points in history. Another popular valuation metric for the broad market is the Buffett indicator, which is simply the ratio of the total stock market capitalization measured by the Wilshire total market divided by the gross domestic product. During periods, for instance, in the 2000s and right now, where the total stock market is above the gross domestic product, that signifies a period of overvaluation. Based on this ratio, we're roughly at the same levels at near the peak of the dot-com bubble. What's important to understand is that these broad metrics of stock valuations are not meant to be a short-term market timing tool, and in no way can they actually predict when the next crash or correction will occur. However, these metrics are highly correlated with long-term expected future returns. Put simply, the higher your valuation level is when you invest, the lower your expected rate of return is for the next 10 years. Investing during periods of low valuation, for instance in March 2009 following the financial crisis, your expected future returns are significantly higher, and overall this is a much more favorable time to invest from a risk to reward standpoint. Another implication of this is that if the Fed continues to intervene in the markets and not allow a normal market correction and economic contraction to flush out the bad or over-leveraged companies, then effectively what the Fed is doing is propping up these declining or unprofitable companies, diverting capital away from more productive enterprises, and ultimately setting up for an even bigger crash down the road. But if there's one thing the Fed is good at, it is blowing bubbles, something that's demonstrated by the ratio of net worth as a percentage of disposable income over time. Now, the ratio of net worth to income has remained relatively stable for most of US history, but following more aggressive monetary policy by the Federal Reserve in recent decades, we've seen that ratio expand dramatically. As well, during this period, incomes were relatively stagnant. The prices for both financial assets and hard assets like real estate and gold have all increased substantially. Now, when it comes to the Fed literally printing trillions of dollars, there's a serious concern, at least long term, of rising and potentially significant levels of inflation. Now, this doesn't automatically mean hyperinflation, in which case you see an almost complete erosion of the currency. However, higher levels of inflation are still concerning because it does erode your purchasing power over time. This chart shows different assets and asset classes that generally perform better in certain economic environments, either during periods of rising or slowing inflation and during slowing or accelerating growth. Typically, during periods of rising or expected increases in inflation, gold is one of the assets that does quite well, which is why it's not too surprising why the price of gold has risen significantly in both 2019 and 2020. Interestingly, developed equities like US stocks typically perform the best during periods of accelerating growth and slowing inflation. However, given the current economic slowdown, it's hard to justify that we're actually in a period of accelerating growth. But right now, I think a lot of this money is simply flowing to stocks and other assets like gold because they can potentially be a long-term hedge of inflation and have at least some positive real expected returns. With the Federal Reserve again dropping short-term interest rates back down to zero, it makes it very difficult for people investing in fixed income like bonds to generate much of a real positive return when taking into account inflation. I think another theme surrounding this disconnect between stocks and the economy is actually something going on specifically within these stock indices, and that's a polarization of markets. Looking at the year-to-date performance of the S&P 500, you can see that it is quite varied. Some companies expected to be net beneficiaries of this new accelerated shift to a digital economy have seen both their stock prices and stock valuation rise during this time. Some examples would be companies like Microsoft, Nvidia, Amazon, Netflix, and PayPal. Companies in cyclical or economically sensitive industries, for instance like financials like large commercial banks, energy and oil and gas stocks, industrial stocks and airlines, and certain consumer discretionary sectors, for instance like travel and autos, are going to be hit the hardest by this economic decline. So throughout this period of uncertainty, I think you're going to see some big winners as well as some significant losers come out of the other side of this. Firms that were highly leveraged and or are in declining industries may not be investments you want to make unless you're fairly confident that the prices decline to a level where it provides you a margin of safety. Possibly a strategy that has less downside risk is to focus on identifying the companies and industries that may benefit from this shift or have long-term tailwinds that are trading at reasonable valuations. The tricky part there is making sure you're paying a reasonable price such that you don't suffer a loss from from a permanent reduction in valuation multiples. So given all that, what are the practical applications for investors? Many people might ask, well, I know stocks are expensive now, but are there really any reasonable alternatives, especially with bond yields so low? Well, to help give you some perspective, I can outline at least roughly my investing plan during this period in time, and it's roughly outlined with this tactical asset allocation guide. Now, you don't need to necessarily have a plan like this, but it's important that you spend time thinking about how you create a plan and then stick to it to avoid getting emotionally caught up in price swings, which could induce you to make investment decisions that are detrimental to your long-term investment success. Now, this rough asset allocation guide was something I posted in March and have made a few tweaks to since, but still remains roughly similar to what you see here. Effectively, with the S&P 500 at higher levels and generally higher valuations, I would retain a larger portion of my portfolio in cash, ideally to deploy that gradually at lower valuation levels in the future. Keep in mind that regardless of valuation levels, I always have at least some assets invested in stocks, as generally speaking, you don't want to try and time the market by jumping all 100% in and out of stocks and going to cash, or going all to cash and into stocks, as simply that just doesn't work very well in the long term, and no one's really created a replicable strategy that it makes sense to do so. Effectively, this is a relatively risk-neutral asset allocation, which gradually gets more aggressive as valuations and expected future returns become more attractive. Obviously, having a tactical asset allocation that changes based on some condition is more complicated than, let's say, a strategic asset allocation, which would be similar to just one of these asset allocations that stays the same regardless of market valuations. One of my favorite websites for exploring these portfolio asset allocations is a website called Portfolio Charts, in which case you can explore both the risk and reward of various portfolios by taking a look at their historical returns and volatility over time and during different economic scenarios. This website can help give you an idea, if you haven't done this kind of thinking before, of what kind of asset allocation you generally like to have based on what kind of investor you are. Along those lines, another practical application for all this information is that with the Fed printing trillions of dollars, and if there's any other economic event that comes up in the future, likely printing even more, you want to make sure you position your portfolio so that you have at least a good portion protected from inflation. Now, the way I'm doing this within my portfolio is to always have at least some asset allocation to gold funds and also always have some asset allocation to equities. These two asset classes will perform much more favorably over the long term compared to returns from cash and bonds. Another thing about fixed income is I have almost all of my fixed income in cash or short-term money market funds. Part of the reason why I don't have any long-term bonds in my portfolio is I think they are one of the least attractive assets at this time, given the combination of extremely low interest rates, which in my mind don't adequately compensate for the high expected inflation risk that should be priced into these bonds. I see no reason why anyone would actively want to purchase a 30-year treasury yielding 1.4%, which effectively, after inflation, locks in a net loss for 30 years and potentially even a very significant loss if inflation increases in the future. I'd be willing to bet that over the next 30 years, gold vastly outperforms the performance of a 30-year treasury bond. And to reflect that sentiment, that's why I have a large proportion of my assets in gold funds. Now, another practical application of all of this information is that given this heightened uncertainty and possibility for more stock market volatility in the future, it's important that you're able to identify and take advantage of any opportunities you can within stocks. For instance, if you can identify a good business with a clean balance sheet or low or no debt, and a competitive advantage or robust business model, if you buy that company at a reasonable price, you're very likely to do well during the long term. A recent example of some projections I did for Facebook using my value seeker model demonstrate this fairly well. In a base case scenario based on these fundamental assumptions, purchasing Facebook at a price of $155 per share means I'm likely to achieve at least a 12% rate of return should these assumptions hold true. During the recent volatility in March and early April, there were several opportunities to purchase Facebook at that price or lower. Investors who did likely saw returns of 40% or more in the short term, but likely will continue seeing long-term returns that are still favorable. Fortunately, I did buy some, but admittedly pulled a bit of a Buffett and didn't buy as much as I should have, which highlights the importance in this type of market is that when you see a quality company on sale at a price that is attractive for the long term, don't be afraid to take full advantage of it. More broadly speaking, even if you are an index investor and don't particularly have an interest or desire to purchase or research individual stocks, you can take advantage of price declines to build up a larger equity position within an index fund when prices come down. Declining prices are no guarantee that the prices won't fall further, and you're not likely going to pick the exact bottom of the market. However, when prices fall, the valuations fall as well, which inversely increases your expected future returns. So going back to what I'm doing in this market right now, I'm mostly being patient. At this point, the index and most stocks in the market are not quite at a level where it's an attractive entry point for me. However, I'm still maintaining a large core position in both equities and gold funds to help protect my portfolio from long-term inflation, while still maintaining a fairly sizable cash allocation, ideally to deploy opportunistically later down the road. As for the specific companies I'm targeting to deploy that capital into, I have a list of about roughly 70 quality stocks that are likely to outperform the market over the long term, and I rank them daily based on attractive entry points. For example, Facebook was one of them that was identified as an attractive entry point earlier in March. If that's something that interests you, you can check that out in the link in the description below, as well as my other resources. Overall, I hope that helps give a little more perspective on the apparent disconnect between stocks and the economy, and what we as investors can do to cope with it. If you have any comments and want to share your thoughts, let me know below. I'll be replying to those this week. Until next time, thank you so much for watching. My name is Michael, and I will see you in the next video.